we don't care. The cost at which it happened, that's where we keep them. So our building would have been kept at the historical cost, the cost at which the transaction occurred. Okay? So though this transaction might have happened 20 years ago, that was the price at which we bought the building. And so that is the record we kept. Debit building, 200,000, credit bank, 100,000, 100,000 debit, 100,000 credit. Okay, fast forward 20 years today. We have done a market survey, or we called a valuer to come and value the building. The valuer is telling us that this building is worth 300,000. Okay, but in the records we only have 100,000. We must make the value to become 300,000. The only way to make it become 300,000 is to what? Add 200 to it. You agree? In accounting, we don't do plus and minus. We do debit and credit. So if you have to do plus on a particular account, you pause and ask yourself, is this account a debit account or a credit account? If the account is a debit account, then to do plus on that account, you must do more debit. Do you get the thinking? If the account is a credit account, and you must add on to it, you must do credit. Okay, so it's just, we have to add 200,000 to it. We know the account is an asset account because it's a building. So it's a debit account, it's an asset. So your balance on that account will be the debit side. If we have to add to an account that has a debit balance, the addition must be further debit to increase it. You will notice that if you don't put it here, you rather put it here. By the time you do your balance carry down, the balance is not 300,000. It's something else negative. Okay, so all I will need you to do is, first of all, identify whether the particular item is an asset or a liability. That's step one. Once you know that it's an asset, the next thing you do is ask yourself, is it increasing or is it decreasing? Okay, and all you need to remember is that an asset that increases must be debited, and an asset that reduces must be credited. Okay? The opposite is true for liabilities. For a liability that increases, you have to credit it. And for a liability that decreases, you have to debit it. Are we okay? I normally don't like doing this because this requires memorization. And if you switch them around, it becomes a problem. But if you understand the thinking that it is an asset, assets, all assets without exception are debit. The only way it can go up is further debits because it's debit. All liabilities are credit. The only way it can go up further is further credit. The opposite is true. Okay. So we will do this for all the assets. So we will take motor vehicle as well, right? So we'll open a motor vehicle account. Right? Take motor vehicle account. What is the balance of motor vehicle? It was 8,000. Is that not it? Motor vehicle is an asset. It must be debit. Right? So the balance of the motor vehicle must be debit. Okay? This is the balance. The examiner now tells us that the motor vehicle has what? Has come down to 5,000. And be careful the choice of words, right? Sometimes he will say has come down to or has come down by So, if he has said had come down by 5,000, that means a completely different thing. So come down to 5,000 is a completely different thing, right? In this case, it has come down to 5,000, meaning it has come down by 3,000. We have to take 3,000 out. So to bring 8,000 down, we have to what? Credit it. To cancel some of it. Is that not it? So we credit it 3,000. What would the description be? The header of the next account, revaluation. And then automatically, we said in accounting, if one is credit, the corresponding is what? Debit. Right. We will do this kind of exercise for all the assets and liabilities that have changed in value. So, you see what I have done now? Even though the partners gained 200,000 on the motor vehicle, they lost 3,000. Sorry, they gained 200,000 on the building. They lost 3,000 on the what? On the motor vehicle. So net impact, they've gained 197,000. That's why I said the revaluation account is used to aggregate all the gains and losses together so that we can find the net gain or loss and share that net gain or loss. We don't want to be sharing, otherwise we would have shared this, then share this, share the next one. It's too cumbersome. Let's put all together in one account. Establish the net gain or loss and share that net gain or loss. Are we together? Okay. So we would have then gone to debtors. Debtors is what? Assets. All assets without exception are what? Debit balance. So debtors. Balance brought down. How much? 5,000. What has happened to debtors? It has reduced by 1,000. Right? But to come down, what must we do? We must cancel 1,000. So to cancel 1,000, we must put it to the credit. So we put 1,000 in. Description, revaluation. So once it's credit here, the corresponding must be what? Debit. Because one credit, one debit. Description being debtors. 1,000. You'll notice that when you do the balance carry down this account, it will be left with only 4,000. When you do the balance carry down on this account, it will be left with only 5,000. When you do the balance carry down on this account, it will go up to 300,000. You follow? There's a shortcut where you don't do this T. And I will show you that. Others may want it, but I prefer this. Because, truth be told, this forms part of your workings in the exams. Okay, this is workings. The examiner is going to, if you check the requirement of the question, what we are supposed to prepare is the revaluation account. So that's what he's going to mark. I do this because it guides my debit and credit and helps me to get the entry here correct. Because if you decide to only do this, unless your debit and credit is sharp, then of course, accounting students can all do this without this. But I prefer you go through it systematically so that your entry here is correct. Because if you start from the asset, you are likely to get the revaluation correct. Are we good? Okay. So we do this. Now, let me say one thing before I switch to the question we saw the question. The last thing I want to say is that remember, goodwill itself is also an asset. Okay? So at the beginning, when you look into the balance sheet that the examiner gives, the balance sheet did not have goodwill, meaning goodwill was what? 0. And it's now moving from 0 to what? 40,000. Okay? So when you debit goodwill, and we say goodwill is what? An asset. So if the asset, we say all assets are without exception what? Debit. So goodwill to start with was 0 and it was debit, and it's moving from 0 to 40. We must add 40 to it, so we must pass a debit. Are we together? The corresponding entry here is the revaluation account. Okay. Remember we said we use the revaluation to accumulate all the increases that has to be shared and all the reductions that have to be shared. We put everything together. Okay. So we will not treat the goodwills separately like we did, where we passed it straight into the capital account. We will rather treat it through the revaluation account. Are we together? Because if you notice, there's an also deduct access to prepare the capital account. So it's one of the increases in assets. Okay? Alright. Having explained that, let's now turn our attention to the question. Okay. So the first requirement says what? Prepare revaluation or what? Or goodwill. Prepare goodwill. So I'll do it again. Okay. And then the second one is revaluation. The second one is revaluation. Okay. So I'll open goodwill account. And then what else did you want us to do? The partner's current account. Okay, it's here. So we have A, B, C, D. Okay. You good? All right. So goodwill has been valued at 40,000. Are we together? You know that, right? Because we said we are not going to be sharing the increases and decreases individually. That's what we want to do. That is why there's a revaluation account. We are going to assemble all increases here and all decreases here before we do the sharing. So goodwill, we know moved from what? So if we were to follow the thinking that we were going through first, if you look on the balance sheet, he gave us a balance sheet right in the question. If you look on it, there's no goodwill. Okay, don't do this in the exam. I just want you to understand, right? So, truth be told, the balance brought down of goodwill was 0, right? Because there was nothing in the balance sheet. I mean, don't do this. I'm just doing this so you will appreciate the concept, following the thinking of what we did first. Now, the examiner says that the goodwill has gone from 0 to 40,000. Goodwill, we said, is an asset. We said all assets are debit. If you want to increase an asset, you must debit it, right? So we must debit it how much? 40,000. What must the description be? Revaluation. Okay? And then in accounting, you say 1 debit, 1 credit. So this one must definitely be credit. And what should be the description? Goodwill. And back to the gentleman who asked about dates. The date is going to be 31st. Because that is the date that all this is happening. And just for convenience decided to ignore it. Right? The admission is happening 31st. Everything would have been 31st December, 31st December, right? Okay. But again, yeah, I said don't need this because it's still. We follow up to this stage. Okay. Then if you take the balance sheet, so somebody give me the numbers in the balance sheet. There's somebody give us balance sheet, right? Somebody give me the numbers in the balance sheet. So there is fixed asset, how much? 120,000. Then there is what? Current asset of how much? 60,000. And then there's what? Okay, so this gives us a total assets of 180,000, right? And then there's capital. Okay. A is 70,000. B is 35,000. And C 20,000. So this must be. Are you sure there must be something else? Accounts payable. How much? 55,000. So when you add everything, you must get 180,000. So this is the status, right? Okay. Now let's start with the additional information. What has happened? They want to admit D into partnership, and because of that, they will revalue all these assets and liabilities to establish what their new values are. Okay, so that they will share any increase or suffer any reduction before the new partner comes. Are we on the same page? Okay. So what, according to the examiner, what is the value of the fixed assets now? I think it's somewhere in the additional information. I think 4. Additional information 4, or I'm not mistaken. So the fixed asset is now going up to what? 150,000. And the current asset? Can you read? Please read. So you see the words here, right? You have to be careful. Accounts payable is by, this is 2, right? This one is by what? 10,000. Okay? What again? A delta will be here. Okay, so you see the examiner here is testing our understanding of whether we know what a current asset is, right? Instead of saying that the current asset change, he didn't do that. He's now telling them a debtor who owes the business how much? 5,000. So that debtor is the current asset. We know that, right? Assets are either current or non-current. We know if the examiner asks what's the distinction between non-current asset and current asset, we know, right? Non-current assets last, or their benefits last for more than 1 year. Current assets usually within 1 year. Okay. So a debtor will definitely be part of this number. So that 5,000 that the debtor owes is part of this 60,000. Now, according to the examiner, what's going to happen? Somebody will not be able to pay. How much? He owes 5,000, but is he not going to pay the entire 5,000? He's dead. Okay, so, and the firm has to write it off. So this number has to come down by 5,000. Are we together? Okay. What's the next sentence? That's all. So fixed asset should go up to 150,000. Current assets must come down by 5,000. Accounts payable, is it up or down? Increased by 10,000. Are we together? Okay. I promise you, with let's finish first. With this, okay, you can actually put your question paper aside and you can finish your evaluation. You can finish your goodwill, and the only thing we have to do is come back to the current account, but that things that you have to deal with, right? So now let's deal with it. So fixed assets. Because in this case the examiner has lumped all fixed assets together, land, building, motor vehicle, everything together. So in our workings, I will open fixed assets account. And I'll start by saying that it's an asset. So it's debit balance. All assets without exception are debit. So my balance on that is what? 20,000, right? Are we together? The balance is 120,000. The examiner is saying that this balance must go up to 150,000. The only way I can get this to move to 150 is by adding 30,000 to it. Is that not it? Okay. Now, to add 30,000 to an asset, I have to debit it. Because if I put it here, I'm cancelling 30,000. I have to debit it, right? So I'll debit it by 30,000. What should the description be? Revaluation. I said the increase and decrease, we are accumulating the revaluation, right? So revaluation. When we say in accounting, one debit, one credit. So if this is the debit, automatically something credit. The description being what? Fixed. The header of the account, fixed assets, 30,000. Are we together? Yeah. The next one is current assets. Current asset account is an asset, so the balance must be debit. So the balance on it, balance brought down, is what? 60,000. Now, I'm supposed to reduce that by 5,000. Yeah? The only way this can go down is for me to cancel 5,000. Right? And it's an asset. So if I want to cancel, I should be putting it on the opposite side. Cancel it. Right? So I'll put 5,000 here. The description being what? Revaluation. One credit, one debit. Description being what? Current assets. 5,000. Are we good? So we've dealt with this, we've dealt with that. The only one left is what? Accounts payable. So I'll open my accounts payable here. Where would the balance brought down of this be? What do you think? Remember, this is a liability. The firm owes people. So the balance is credit. So all assets are debit. All liabilities are credit. Right? So the balance of the accounts payable. It's a credit balance of how much? 55,000. Right? And the examiner says that this has to go up. Maybe it's because the firm has been owing this supplier for some time now, and interest has now accrued on it. Okay, because they failed to pay when it was due. So whatever it is, we don't know, but it has to go up. If an account is credit and it has to go up, it has to increase, what do? You credit it further. Because when you debit it, you'll be cancelling some of it. You get it? So, and the description will be what? Revaluation. So you see. And one credit, the next account was what? Debit. So here, description will be the header of the other accounts. Accounts payable. 10,000. We good? Are we okay? So technically what we've done is we've accumulated the gains on assets here and accumulated the reduction in assets or the loss from liabilities here, right? So the net impact is all in this account. Goodwill went up, is to the credit of the partners. Fixed assets went up, is to their credit. Current assets reduced because a debtor died, is to their detriment. Accounts payable, liabilities went up, is to their detriment. The net effect is that we check and say we have to balance off technically, right? We have to balance off. But in this balancing off, we are going to share the net gain or loss between the existing parties. Because remember, the reason for the revaluation is to establish what gain or loss has been accrued to the existing partners for them to benefit from it before they admit the new party. Are you together? So we know that they have gained 70,000 and they have lost 15,000. Are we together? So technically speaking, they have gained 55,000. Is that not it? But they gained 70,000 and they lost 15,000. So the net impact is that they have gained 55,000. Is that not it? So that 55,000, which is the balance of this account, will be shared between the existing partners in their current profit and loss sharing ratio before they admit the new party, because they created these values and they must benefit from it before the new partner comes. Okay. So now we know that if you add here, you get 70,000. When you add here, you get 55,000, right? So we said when you're balancing account, I said check both sides, yes. The bigger one at both sides. Right? But you and I know that this, if you cast, it will tally, no problem. Here, when you cast, it doesn't. Ordinarily, we should have called it balance carried out, ordinarily. But we are saying for this revaluation account, that is the gain on revaluation that ought to be shared among the existing partners. Okay? So you then, the difference, which is 55,000. Okay, you are going to share, we say, current account. You will share it, right? And when you share it, you credit the partner's current account so that in future, if they have to take it, they can take it. Right. So, yes. Which one?
Under the revaluation.
This one. Sorry, it's 5,000. 5,000. Remember, if you look here, the current asset, the examiner said that a debtor who owed the firm to the tune of 5,000 had died. So it means our current asset must come down. Okay. Okay, so current account, right? And then it will be A, B, and C only. The existing partners only will be the ones sharing in this gain. Are we together? So now, the examiner has given us their initial profit and loss sharing ratio, right? We had what was that profit and loss sharing ratio? Please do. Somebody check for us. Yes. Yes. When they were just three. When they were just three. 4 is to 1. Okay. So this is A, and this is B, and this is C. Now the total is 7, right? So A, when they divide this game into 7, A will take 4 of it, right? B will take 2 of it. And then C will take 1 of it. Are we together? So we're sharing this into 7. A takes 4, B takes 2, and C takes 1. Right? So 4 plus 2 plus 1 is 7. Right? Okay. So when you share, what do you get? 7 goes into 55. 7, 7, 49. 6. Okay, it's not a perfect one. Okay, somebody go for me. 4 over 7 of 55. 31, 4, 2, 8. Point what? 0.5. So I'll make it 2.9. Okay, the next one. The next one will be half of this, right? So that's what 60. That's 15 and a half. 15,500, 15,700, 15,710. It's 1, 5, 7, 1, 4. Wait, what? 0.2. So we can. Okay. Then obviously this will be half of this. 7, 5. 7, 5. This is what? 700. So that is what? 350, 7, 5, 850, and then 40, 7. We are getting correct. Okay. So this is how they share, right? So we good? Okay. So A gets what? 3, 1, 4, 2, 9. B gets 1, 5, 7, 1, 4. This one gets 7, 8, 5, 7. So that it adds up to 70,000. Then the corresponding credit will go into the what? Current account. But before we do that, do we have balances in the current account? No, we don't, right? The examiner did not. If you look at the question, the balance sheet the examiner gave us, did he give us? No, he didn't, right? We only have capital. The current account didn't have balances, so we don't need to worry about that. So all we need to do is the revaluation. See, this one, they have posted the corresponding credit, right? Revaluation. And like I said, it's the header of the account, right? So here, A is 31, 429. B is 15, 714. C is 7857. Nothing is here. Right? So now, these guys have enjoyed the benefit of the revaluation. But that is not the end of the story. Because the examiner did say that they will not keep goodwill in the books. Remember? It says they will not keep goodwill in the books. And as it stands right now, they are keeping goodwill in the books. As it stands right now, they are keeping goodwill in the books. Ideally, the examiner should have asked for a capital account. I don't know why they did it. It says current, so we'll do his current account for him. So we have to write off the goodwill. Okay, we have to write off goodwill. And I said, when they are not keeping goodwill in the books, it means by the time we are done, the goodwill account must balance. There should be no balance on the goodwill account. Right? So we have to write it off. So how do we write off a goodwill? As a credit. You take it out, you can't. See, it's an asset, so you take it out. And then once you credit it, ordinarily, in the previous example, would have been debiting capital account. Right? But remember, when the goodwill has actually been shared and is sitting here, so we'll rather pass it to the current account. Okay? Because he didn't even access to do the capital account in a way. Now it's going to be A, B, C, and D. Remember, D has now been admitted. Okay? D has now been admitted. And the write-off is going to be done in the new profit and loss sharing ratio. Because there's a new partner. You can't use the old ratio anymore. There's a new partner. Okay. What is the new profit and loss sharing ratio? Let me clean here, right? I'll clean this one. So we've got A, B, C, D. 3, 2, 2, 1. Total 8. So 3 of 8 times 40,000. 2 of 8 times 40,000. Another 2 of 8 times 40,000. And 1 of 8 times 40,000. What do we get? I think we've done these numbers already from 15,000, 10,000, 10,000, 5,000, right? So we credit this. This guy gets 15,000. This guy gets 10,000, 10,000, 5,000. So the goodwill account balances, right? Should be no balance for it. And then we have to pass the corresponding credit here. A is what? 15,000. B is 10,000. C is 10,000. And 5,000. Remember, it's just double entry, right? You credit and you must debit. Are we together? We credit, we must debit. We good? Okay. So let me, up until the last entry I made, we were okay, right? Up until the last entry. Remember we said accounting is double entry. When you pass a debit, you have to pass a corresponding credit. Or when you pass a credit, you must pass a corresponding debit. We never do single entry in accounting, right? We're good. Okay. Then we said the goodwill had to be written off. That's what the examiner said. He said the partners do not intend to keep goodwill in the books. And then you remember I said, if that is the case, it means when we are done, there should be no balance on the goodwill account. The goodwill should balance by itself automatically, right? And then we said that in order to write off the goodwill, we do it in the new profit and loss sharing ratio after the admission of the new party. Remember, the whole point of the revaluation is to enable us to admit the new party. Remember, right? So once we have brought goodwill in the books, and we have successfully admitted a new partner, we have to write off the goodwill, just like we did in the first example. The only reason you are not seeing the admission of a partner is because the examiner has not asked us to do the capital account. The examiner did not ask us to do the capital account, so I did that other approach just to refresh our memory of what we learned last week. But as far as this question is concerned, the examiner wants us to do a current account. If we do a capital account, we'll get no marks on it. I'm sure the marking scheme will not allocate any marks for it, right? So to write off the goodwill, we know that if the goodwill is an asset, it's in the books. You want to get it out of the books, to cancel it, credit it. But we know in accounting, we don't do single entry. When you pass a credit, there must be a corresponding debit. In the previous example, because I was using a capital account, the corresponding entry went to the capital account. Here we are not asked to do the capital account. Corresponding entry we put in the current account of the partners, because the goodwill is sitting here anyway, sitting in the current account. That's what they shared. You remember, the goodwill formed part of the profit that was shared, because they got 70,000 and they lost 15,000. So the gain of 55,000 that was shared, the goodwill was inside that, and that's sitting here. So if they are writing it off, you debit the current account. You credit goodwill to take it out of the books. Corresponding entry without thinking, automatically it must be debited, but there cannot be two credits. So we're debiting here, and it's the same number. So you credit 15, you debit 50. You credit 10, you debit 10. You credit 10, you debit 10. You credit 5, you debit 5. Are we together? Okay. So we're done with the goodwill. Requirement 1. We're done with the revaluation. Requirement 2. Requirement 3 is what? The current account, which is what we're doing right now. Right. And then the last one is what? We have to prepare the balance sheet. Okay, but the balance sheet is actually very easy. In fact, we are almost done, because you see you have the numbers here. Fixed asset to now be just 150,000. Current asset to be what? 55,000. When you come here, capital. This capital has not changed. This one has not changed. This one has not changed. D came in and brought what? 80,000. So D will have 80,000 capital. This guy went down or went up 10,000. So this becomes 65,000. Then you bring the balance on the current account. You are done. It's actually really straightforward. So that's why I intentionally did this, because when we get to that requirement, it's pretty straightforward. It is. So you may not even have to rely on this if you don't want to. There are people who have done like this. I mean, accountants like this, but for us non-accountants, you can just stick to this. You can do this on your question paper to make your operation of the balance sheet very, very easy. Okay. So now that we are, I can clean this, right? I can clean this because I don't want to bother you with this balancing. I will go with this approach, which is easier. You do the balance sheet. Okay. So now we have this. Nothing further, right? Is there any additional information we have to be mindful of? Additional information, one says what? Can you check one for me? Sharing ratio, that we know. Okay, we've dealt with. Second, we've dealt with that. 3. D brought in 80,000 cash capital. That's why there's a bit of. Okay, we'll explain that. So that we are done with this. All we need to do is to balance it off. Okay, we'll balance this off. So you know how to balance account. We said, what do? Balance A against A. Check the bigger of the two totals and put at both sides, right? Leave enough space, since you don't know where the balance carried down is going to be. Leave enough space on both sides. Normally I will do 2 spaces on both sides, right? Sometimes you are writing, you make a mistake and you don't cancel, and you still have one more space to use. But yeah, just enough space. So look, you can even leave 3-4 spaces. Nobody really penalize you for it. So this is 15,000. This is 31. Obviously this is bigger, right? So I'll write this on both sides. 31,429. Are we together? So this is perfect, but this is not. So obviously this will be my balance carried on, right? 16,429, right? 16,429. Are we together? This thing is what? Is it 5? Is it? The revaluation? Yes, it is. So that will be 15, right? So 15,714. I'll put the same thing here. 15,714. We together? So this obviously is 5,714. I think this side and this side is bigger, right? So I'll put a bigger one, 10,000. 10,000. And you see why it's good to leave enough space on both sides. But this time around, the balance carry down is here. But this is okay, but this is what? So we'll have a balance carry down rather here. So this is, and this will be what? So this will be 3,0,6,4,0,9,1,0,8,2. Right? And the last one, again, this side is bigger. There's nothing on the other side, right? So 5,000, 5,000, 5,000. We good? Every balance carried down must be what? Okay, don't forget, please. Balance brought down. Here is nil, here is nil, here is 2,143, and here is 5,000. We are bringing these ones down. And therefore, C and D, and that's why I'm bringing it for C and D. Then we'll bring these ones also down. Balance brought down. We have 16,429, and we have 5,714. That's nothing. We're good. Now let's prepare our balance sheet. And this is where you must pay attention to details, right? The only tricky thing here is that, remember when C brought in capital, the firm would have received money. So if we are giving C 80,000 capital, our current asset must go up by 80,000 because bank would have gone up. Do you agree with me? Okay, so that's the only trick here that you need to remember, that the introduction of the capital by D impliedly or necessarily requires that our current asset go up. Because if you give him credit for capital, there must be a corresponding debit entry. Where is that? Bank, because he brought the money. Are we together? Okay. So balance sheet. And your header, please don't forget your header. You get your marks for it. So there's A, B, C, and D partnership. Or they may decide that they call the partnership firms by some other name. Whatever name the examiner gives us is the name you write. I'll come back to you. Then you call it, they say, well, me, I always use the wording of the examiner. I don't try to be creative. If the examiner says prepare balance sheet, I say balance sheet. If the examiner says statement of performance, I say statement of performance. Whatever he uses, that's what I use. Okay, what did he say? So he says balance sheet. So balance sheet as at January 2013. Whatever he says, that's what I will do. And I will copy his format for him. The format in the question, the same format I will use for him. Yeah, I don't complicate my life. Okay. Yes. You wanted to ask a question? You good? Okay. So now we're going to do the balance sheet, right? And I said I'm going to copy the examiner's format. Okay. I don't complicate life. If he gives me a T balance sheet, same one I'll do in the exams, even though I know that one is archaic, but I promise you, stick to his format. So, fixed assets. What is the value of our fixed asset now? 150,000. Current asset. Our current asset, it used to be 60,000, not so. And then we went down by 5,000, and then we got 80,000 cash in. Yeah? So our current asset now becomes what? This 140, 135, right? becomes 135,000. Are we together? Total asset 285,000. Are we together? Financed by okay, so you see, I have been too fast. So look at what has happened here. You see the current account. There are two types of balances on the current account. There's some balance brought down here, and there's some balance brought down here. So the current accounts are of two types. Some, the partners owe the business, and some, the business owe the partners. Agreed? So for the current account that has a debit balance, we said debit balances are what? Assets. And credit balances are what? Liability. So for the debit balances that are here, they are what? Assets. Okay. So when we count, so what I should do is I should say current account. And then we have what? Who are the guys who have the debit? C. C's debit is how much? 2143. And this is what? 5,000. You could have added it to the current account as well if you want the current asset. If you wanted to do that, there's no problem. But I just want to show it differently. So now I will go to somebody add for me, financed by what do you get? Very good. Okay, 3, 4, 1, 7, 12, 2, 1, 4, 9, 9, 2. Yeah. Are we good? Sorry. You don't understand this? Okay. How I did it? Okay. You understand how we balance off this account? You understand that one? The balancing off. When you balance off an account, and it is one of the reasons why we always say that every balance carried down should be brought down. Always, don't forget. So when we finish the balance carried down, we also brought it down. Remember that some of the balance carried down was on the debit side, and some was on the credit side. They must be brought down. The balance carried down on the credit side will be brought down where? To the debit side. We bring balances down on the opposite side. So these balance carried downs, we brought them down here on the debit side. Then these balance carried down that are on this side, we bring them down on that side. Are we together after this point? Okay. Now, these balances belongs to the respective partners. This one is for C. This one is for D. This is for A. And this is for B. But this is the record of the partnership firm. Okay. So according to the partnership firm, it has a debit balance of 2,100 against C. That means that C owes the firm. C is a debtor to the firm. D is also a debtor because he has a debit balance. If you are the accountant of the firm, you call Mr. D and tell him that your balance with the firm on your current account is debit, meaning you are a debtor because debtors have debit balance. You are a debtor to the firm. You owe us. So as far as the firm is concerned, you are an asset to us. And you can't say that to Mr. A and B because their balances are on the credit side. So as far as B and A are concerned, the firm owes them. Are you with me? So the firm has a liability towards Mr. A and towards Mr. B. So when the firm is counting its assets, it can count this one and this one, which is what I have done here, because I'm counting assets. But I cannot count this, because this is a liability. I'll count this when I'm doing the liabilities, or I'm counting the liabilities of the firm. Are you with me? I must say, this question has everything. This question has everything. Okay. So we are done with the asset side. Are we okay? Now finance by, I'm copying the same format, right? As the examiner. Can I clean the top? I can clean this one, right? So let's assume that I have shifted this up, right? So I'm continuing. So finance by. So it's going to be financed by what? Capital, right? I'm using the examiner's form. A, B, C, and D. What is A's capital? It has not changed, right? 70,000. Is that not it? What is B? 35,000. C? 20,000. D? D. Your D has been admitted now. 80,000. Are we together? Then we go to accounts payable. How much? Yes, 65,000. Then current account balance. And this time, it will be what? A and B. Because they are the ones that the firm owes, right? They have the liability. We have liability against them. So A and B. Remember, when it came to the asset, it was C and D. Right? So A is what? 16,429. And then 5,714. When you add all this, you must get this. Somebody add them for us. Two 9,2,1,4. And you can say your balance sheet has balance. But truth be told, you can do this in 15 minutes. I promise you. If I agree that he has everything in it, but think about it. He never asked us to do the capital account. All those things we were doing, the things we started first with was not part of this question. We wanted to gain further understanding from last week. So that wasn't the examiner's requirement of us. You get me? So, truth be told, it's just a good, in fact, as for goodwill account, the requirement 1. Because it says write it off. So bring it into the books with the existing ratio, write it off with the old ratio. So if at 2 minutes you can finish goodwill. No, just think about it. The goodwill is 40,000. What's the principle? Bring it into the books at the ratio of the existing partners. Get it out of the books using the new ratio. 2 minutes, you can finish goodwill. You need to balance. You are done. Because, it will always be like that. There will be no exception. That bring the goodwill into the books at the ratio of the existing partners. If goodwill is to be written off, write it off using the new ratio after the new partner has been added. That principle will never change. Never. So goodwill, 2 minutes, you are done. Then you move to revaluation. Yeah. Okay, so this is not capital, this is current account. By D. Oh, why we brought it here? So remember we said accounting is double entry. Every transaction affects 2 items, one debit, one credit. If a partner introduces capital into the firm would have received money. You agree? So money would have come into the business. So we'll debit bank. Bank forms part of the current assets. And that's why current asset must increase. Then the corresponding credit will be the capital account of the partner. So the introduction of, can I claim this side? When the partner introduces capital, these are the entries that we're supposed to pass. Assuming he gave us a check, or he made a direct bank transfer into the firm's bank account. Our bank account, the firm's bank account, would have received money, 80,000. And the person giving us the money is partner D. He gave 80,000. Description here will be bank, the header of the other account. The description here will be capital, the header of the other account. So by doing this, we have increased our bank balance. Bank forms part of current assets. And that is why the current asset is supposed to go up by 80,000. Because remember the balance sheet he gave us, this number was before the admittance of partner D. So we can never say that this balance has already taken care of the 80,000. Are you with me? Well, this was before the admitted D. So upon the admittance of D, our money must go up, must increase. So our current asset has increased. Are you with me? Any other question? Okay. So I think what I'll try and do. So I think this will bring us to the end of partnership. What we'll try and do is go through the past questions. Okay, we'll go through the past questions. We'll retrieve all the partnership questions. We'll start from the latest, right? The previous sitting, right? We'll go back, and retrieve all the partnership questions and put them on the page. And please give it a go. And if you face any obstacle, give us a shout. Or when we meet again, we may explain before we move to the next topic. I think the whole idea is also that we just don't want to finish. We want people to understand, right? Today we have just solve one other question and then move on to the other. But then we got the feeling that we need to take our time and solve some more questions. So if we distribute the questions and we get a feeling that people are not comfortable yet with partnership, I'll consult with senior and we may have to spend some more time on it if need be. That's the whole essence. We just don't want to finish. We want to make sure that we are very, very comfortable. Are we on the same page? Questions, comments, contributions, suggestions, criticisms? Okay. If we go then, thank you very much. I think, please hold on, let me hand the microphone to Mrs.